It's wanting to get assigned on the cash secured puts to buy the stock, wanting to get assigned on the covered calls to sell the stock. And really, fundamentals are going to be our best guiding star for that. The trade objective means that we use the strike price to target where to get in or out of the stock. We can use options to target a dividend yield, as well as the PE ratio, the price to book ratio, even the price to operating cash flow ratio. We do this by calculating at what stock price the ratios become attractive and set cash secured put and covered call strikes accordingly.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 44, Secret Sauce. But before we jump in today, let's talk about how you can get the most out of the Wealth Building with Options community. Help grow the Wealth Building with Options community by subscribing to it in your favorite podcast app. And if you're already a listener, you can support the show with a paid subscription. When you do, you'll get video extra podcast episodes so you can get hands-on video training on things we talk about on the show. Subscriber-only posts where I'll drill down on a stock, event, or trading opportunity and share trade ideas. You'll get all my covered call and cash secured put trades that I'm making in my real brokerage account. You'll get access to our monthly online Ask Me Anything webinar, and you'll get our unusual options activity alerts on options income trades like credit spreads and much more. And the best part is your paid subscription helps keep this show on the air. To join, just go to wealthbuildingpodcast.com and choose your subscription level. That's wealthbuildingpodcast.com and just choose your subscription level. I'm recording this not too long after we had the Black Friday, Cyber Monday sales that we have every year. And there's some things that sometimes I wait for. There are a couple of things. One, I take these pretty expensive probiotics, but they work. I'll be a spokesman for them if they ask me. And I also take these sleep aids. The probiotics, you kind of have to do them every day. I ran out, but being a trader, I always look at value versus price, and I like to pay less than value. And those do have a lot of value, so I'm going to keep buying them, but I wanted to get a good price. So I waited for Black Friday or Cyber Monday for both of those two things, probiotics and the sleep aids. And I waited. And then Black Friday, Cyber Monday came, and I bought them, and I got a nice discount. This waiting for that opportunity to buy at the right price, it's kind of the nature of, in some regard, it's the nature of all trading, but it's really the nature of trading and investing when it comes to wheel traders. In fact, really, on two levels. We want to wait to get the right price on the option that we're trading. And sometimes, particularly with the trade objective, we tend to wait to get assigned at the specific strike price. It's very, very strategic when it comes to the old price versus value investing and trading sort of thing. When it comes to the wheel, we're always waiting and waiting patiently because you never know when it's going to come, when you're going to get that price on the option, or specifically what we're going to talk about on this show, when you're going to get assigned at that strike price. I mentioned something just a minute ago, and I've mentioned it a number of times on the show already. Those of you who are long-term listeners knew exactly what I was talking about when I said it, but let me revisit it for a second here. I said trade objective. When it comes to trading the wheel, you can have one of two objectives for making the trade, and that's it. You can only have one or the other one. The skate objective or the trade objective. The skate objective is when I sell a covered call or a cash secured put with the objective of not getting assigned. I want to sell it and skate, meaning expiration comes around, they expire worthless, and I keep the money. Great. The other objective, the trade objective, is where I sell a covered call or a cash secured put with the objective of trading into or out of a stock position. I want to get assigned. And that is also a common objective. For me, it's probably more often the objective than the skate objective. Now, there's another dynamic duo here when it comes to the secret sauce of wheel trading, and that is fundamental analysis or technical analysis. Now, technically, get it? Fundamentally, there's really what I call the trifecta of analyses. There's actually fundamental, technical, and volatility analysis. But fundamental and technical analysis are for analyzing the underlying. Volatility analysis is for analyzing the options. So we got these two pairs, skate or trade, fundamental or technical, and we can kind of match them up a little bit. It's sort of like a Venn diagram where there is still a little bit of overlap among the ones that are not matched up, but it goes kind of something like this. If I have the skate objective, I tend to want to use more technical analysis. If I have the trade objective, I tend to want to use more fundamental analysis. Now, this is subjective. This is my opinion. You talk to somebody else and they'll have a somewhat different opinion. But I think there is still a common thread probably around most people's opinions who do this sort of thing a lot, trade the wheel a lot, and have gotten good at it. And I think that even if I have to twist an arm or two, I think most people would agree with what I'm saying here. Skate objective, usually technical analysis. Trade objective, usually fundamental analysis. We can pair those two things up. Now, the reason why I say the trade objective should typically rely more on fundamental analysis is because the trade objective is about when to buy the stock or when to sell the stock. It's wanting to get assigned on the cash secured puts to buy the stock, wanting to get assigned on the covered calls to sell the stock. And really, fundamentals are going to be our best guiding star for that. The trade objective means that we use the strike price to target where to get in or out of the stock. We can use options to target a dividend yield, as well as the PE ratio, the price to book ratio, even the price to operating cash flow ratio. We do this by calculating at what stock price the ratios become attractive and set cash secured put and covered call strikes accordingly. So let's start with an example based on the dividend yield. Let's say we have a stock trading at $100 a share, and you receive a quarterly dividend of $1.10 on that. So $4.40 a year that you make on a $100 stock. So basically that's a 4.4% yield. Now we'll assume that that's not really enough to be attractive for this particular made up hypothetical market environment we're talking about in this made up hypothetical example. I think there are probably sometimes when that could be a good enough yield, and sometimes when I think it's definitely not. We'll talk more about that in the next example, which is going to be a little bit more realistic of an example. But let's continue with this one. You do your analysis and find the company to be fundamentally, fair to Midland. Maybe the PE and price to book and price to operating cash flow, or they're just maybe a little bit too high to warrant buying the stock. You expect the company to raise the dividend to 117 next quarter, we'll say, because going back in this, again, made up example, that would be a conducive rise for the dividend, given past dividend policy behavior or whatever. Maybe they normally raise it around 5% a year, right? So, okay, that means that we kind of have to adjust our dividend yield in our head. We have to say, well, no, it's not 4.4. It was 4.4, but now it's not 4.4. Now it's 117 times 4 is 4.68% yield. So a little better. But we'll assume maybe that's not just quite there just yet. So what are we trying to figure out here? Well, we want to decide, look, if we're even going to consider this stock, and there's thousands of other stocks out there, opportunities, we don't have to trade this one, but if we were to trade this one, what dividend yield would I find attractive for this stock? So let's imagine that we target a 5.75% dividend yield. Well, how do we set our strikes? All you have to do is reverse engineer the price that the stock would have to be trading for the dividend yield to reach 5.75%. So I think we talked about this last show. The dividend yield is calculated simply by taking the annual dividends divided by the stock price. Really, really, really simple. Dividend yield is annual dividends divided by the stock price. So here's what we do. We do a little algebra, okay? We multiply both sides times the stock price and divide both sides by the dividend yield. Here's what we get. We get the stock price equals the annual dividends divided by the dividend yield. So the stock price that we would target wanting to buy the stock, which is where we would set our strike price, that target stock price is just simply the annual dividend. So in this case, 4 times 1.17, 4 times $1.17, divided by the dividend yield we're targeting. So in this case, 5.75%. Now, that math works out to you. You might need a calculator here for this, but it's pretty simple arithmetic. 4 times 117 divided by 5.75. Well, actually 0.0575 because it's percent. That comes out to $81.39. So what that all means is that when the stock reaches $81.39 a share, the yield will have become, the dividend yield will have become $5.75. Okay. I set the target stock price to get the target dividend yield. So what I do sometimes is I enter a good till cancel order to sell a put, cash secured put, with an 81 strike price. If the put results in assignment, whether that's early assignment or at expiration, the goal of locking in that stock at a 5.75 dividend yield is achieved. You see how that works? And now if the stock doesn't fall enough to result in assignment, the profit's defined by the skate yield, which I think we talked about before, and we're going to talk about it a whole bunch more in the next coming episodes. Incidentally, if the stock falls, resulting in the dividend yield rising, well, all the price on top ratios that you want to be low, they get better. The PE ratio, price to book ratio, price to operating cash flow ratio, they will all have gotten smaller, making the investment better by multiple fundamental criteria. Again, this assumes earnings, book value, and operating cash flow remain the same and only the price has changed. Logic follows that we can therefore set a target price for any of those metrics as a focal point, as a matter of fact. Now, sometimes people ask me about this. I say, okay, if I'm going to target the 5.75% dividend yield and the math works out where the target stock price is $81.39, well, Dan, if you're selling the put for something, I don't know, call it 90 cents or something, couldn't I just sell the 82 strike, get a little bit closer to the money? Because if I got assigned at the 82 strike, I'd buy the stock at 82 minus the 90 cents that I collected from selling the put. My effective purchase price or my break even would be $81.10. So couldn't I use the 82 strike? And that answer is yes. We have to do some math. We have to be sort of left-brained and scientific, but there's some margin for error, right? I mean, we're traders here. In a sense, things don't have to be perfect. They just have to be logical. So yeah, you can factor in the put premium as well. But do you kind of see what I did there? I created this pretty magical thing where if I want a 5.75% dividend yield, if I get assigned, kapow, I just achieved it. If I don't get assigned, then I skate on the put and I made money. In any kind of public talking about options or anything like that, I always have to be compliant. You always have to make sure you're not over-promising and that the powers that be, if they hear what you say and they want to critique it, that you're being accurate and doing a service for the people you're talking to. So I don't really want to go as far as saying it's a win-win, but it's kind of a win-win. I mean, you can make a case for saying, yeah, but what if the stock collapses down to 50? Well, then you got your butt handed to you on the stock and you lost a bunch of money on it, which is true. But you still locked in a 5.75% or whatever dividend yield. And if you were going to buy the stock anyway to get that yield, you would have lost that money anyway. And you can also say, but Dan, what if the stock went up like to 120 bucks? Then you left a ton of money on the table. Whoop-de-doo, you made 90 cents in option premium, but you could have made 40 bucks if you just bought the stock. That's true too. But that's a different game. That is a different objective. We're not setting out about doing this for the purpose of buying the stock now to make money on stock appreciation. That's not the goal. That's not what we're trying to do. Like, if we get assigned and that magically happens, I mean, sure, I'll take the cash. Why not? But that's not what I'm trying to do. If I go to some sort of like convention, car show or something, and I'm walking around the exhibit hall and somebody has one of those throw your business card in the fishbowl thing, and all of a sudden I won a brand new car, well, that's great. I'll take it. That's not what I was there for. I wasn't trying to do that. It was just this dumb luck thing that happened. And if I don't win, I'm not going to be mad because that's not why I'm there. That's the same thing. So I find that to be a pretty lousy argument. Now, if your objective is different, if your objective is, hey, man, I think this stock is really going to take off to the upside, I got to get in this sucker. Well, then you're not doing what we're talking about. That's a whole different game altogether. You do something different. You maybe just buy the stock, or you buy calls, or you're selling in the money cash secured put. So let's talk about setting the strike based on the PE ratio. Different made up example. Okay. Imagine a stock is trading at $117.43. Its trailing 12 months earnings are $6.91, giving it a PE ratio of 17. As a quick refresher, the PE ratio is the price to earnings ratio, which is calculated by taking the stock price divided by earnings. So 117.43 divided by 691 is 17. And again, I know it's hard to remember all these numbers. Good news is we're going to have a video extra where I'm actually going to video record the next example that I do so that all of our paid subscribers, which again, I do encourage you to do, it's only like, it's very, very inexpensive. It's like if you buy one fancy coffee a week, this is less. And you get so much more out of it than a fancy double half mocha latte, extra whip, whatever. This takes you a whole bunch farther in life. Anyway, what if I don't like a 17 PE ratio? I want to target buying this stock at a 12 PE ratio. You can't do that now at this current stock price, but if the stock price falls, that makes the PE ratio smaller. How far does it have to fall in order for it to go from 17 PE ratio to a 12 PE ratio? Same thing with a little bit of algebra. Instead of PE equals stock price divided by earnings, all we have to do here is, well, basically rearrange that equation to stock price equals PE ratio times earnings. That's the target stock price, that is. So if the target PE ratio is 12, then we just take 12 times the trailing 12 months earnings, 691, and that comes out to our target stock price. This stock would have to fall to 82.92. Why? Because 12 times the trailing 12 months earnings of $6.91, 12 times 691 is $82.92. Note that the math seldom works out perfectly to an exact strike price. That's why I said before 81, 82. Actually, it's kind of a funny coincidence that we're in the same sort of handle here, 82. But rounding to the nearest strike price is always necessary. The math is never, I mean, I shouldn't say never, it will sometimes, 1 out of 100 times, I guess, work out to an exact strike price. Maybe the 83 strike puts are available. Because the target strike is rather far from where the stock is trading now, it's got a long way to fall. I probably need a longer dated 83 strike put. I'd probably have to go pretty far out in my expiration selection because otherwise I'm going to be selling way, way, way too low of a premium to justify the trade. So let's go through one more example here. And this is a very real example. And this is going to be for our paid subscribers. Like I said, I'm looking at a chart of Verizon, symbol VZ. And this is a stock that I have a position in. And I have a position in this stock for the reasons why I'm talking about. Verizon was paying a quarterly dividend of 67.8 cents a quarter. They just raised the dividend last quarter to 69 cents. The stock price is actually lower now than it was when the dividend was lower. So the yield got quite a bit better. Is it good enough? Well, we'll get to that in a second. In order to consider this for a candidate, though, yes, I do care about the dividend yield, and whatever price that I select for the strike price, if I end up getting assigned, I am locked in at that dividend yield. So what if the stock really tanks? Well, I can very brazenly say that it doesn't matter, because whatever I paid for the stock, even if I can't sell it for that much now because it's lower, I'm still collecting that dividend going forward on that amount that I invested. As long as the stock ends up going higher at some point in the future, doesn't have to be tomorrow or next week or month or even year. It could be 5 years from now for all I care. If I like the dividend yield, great. But that being said, I really kind of prefer that the stock doesn't just fall out of bed and I'm down on my principal. So I also like to look at some of those other ratios. Now, I'm going to kind of oversimplify just a little bit here and say that where Verizon is right now, $40.67 as I record this, it's got about an 8 PE ratio, which is like really low. So I'm pretty emboldened to buy the stock here. But if my real objective for doing it is the dividend yield, let's take a look. Since they just raised the dividend last quarter, and it tends to be their policy to keep the dividend steady for a year at a time and then maybe raise it, I'm just going to take out my handy dandy little $5 calculator here and take 69 cents a quarter times 4 quarters, because that's what it's going to be in the future. It's not really the trailing 12 months. It's from here on out. That's $2.76. So I take $2.76 divided by the stock price, which, as I'm recording this, and I'm sure it's changed now that you're listening to it, I'm going to take 276 divided by 40.67. That comes out to a 6.79 dividend yield, which is already pretty good, in my opinion, for my purposes. And I'm making this personal because my objectives might be different than your objectives. Here's the way I look at it. I'm looking at my age, and I think I have plenty of time before I kick the bucket. Definitely have some time before I retire, but not that much time. I mean, I like the idea of being pretty conservative. And the one thing that I know is that historically, on average, the S&P 500 makes about 10% a year. Is it guaranteed to do that next year? No. Over the next 10 years, should it do 10% a year? I mean, if history continues like that, it should, might not. I mean, it won't, but that's my best guess. It's probably anybody's best guess. So if I can make let's just call it 6.8% dividend yield on this, that's a little less than 10% a year. So maybe that's not as good as just buying and holding the S&P 500. But a couple of things here. One is I've also got some stocks that are pretty aggressive and I want to make money on price appreciation. This is a different play. This is the more conservative play. So one of the things that I do is I compare it with how much I can get just by letting my money sit in a money market account in my IRA. And that, I didn't look at it today, but it's somewhere around 4%. So this is more than, this is 6.8%. This is a lot better than 4%. There's more risk in case it goes down, but at a 8 PE ratio, I believe it's less likely to continue going down than to continue going up. I don't know that for sure, but this is how value investors think about it. Probably, in my theory, I think I'm probably likely to make money over the next couple of years on the stock also going up. So dividends being significantly higher than just the regular old interest rate with more risk, but I don't believe that the risk can be quite that big. I like it from that standpoint, but I also like it from the standpoint that I think I'm probably going to make money on stock appreciation over the next couple of years also. So even though on a very conservative part of my portfolio, I don't feel that I have to make 10% because hopefully on the more high flyers that I pick, I make more than 10%. And on the shares of spiders, I make whatever the market is. So it's the combination of dividend yield plus the potential for price appreciation. Now, okay, let's go back to that here. So 0.69 times 4, again, 276 divided by 40.67. What if your objective is a little bit different? What if your objective is, hey, I don't care about the price appreciation, but I know that I can get a 7.25 dividend yield on this other stock that I think is equally as conservative. Okay, you want a bigger dividend yield. So what do? Well, you just take your annual dividends. So again, 0.69 times 4 equals 276 divided by my target yield. So what did we say in theory you wanted? 7.25 yield. So we take our annual dividends, 6.9 times 4 is 276, divided by 0.0725. And that is $38.07 in the price of the stock. So what I would do is I would put in order to sell puts at $38 strike price. Now, that's assuming that I can get a big enough yield for them. So one thing I'll do is I'll pull up the option chain. Let's bring this to 12. Go out 16 days. Selling the 38 strike 16 days from now, all I can get is a nickel. That's terrible. I'm going to have to go out further in time. What if I went out to the January 38 strike? I could sell at 30 cents. I could probably get 31 cents. I can't, there's no 38.5 strikes. So selling the 39 strike at like 53 cents, I won't hit my target dividend yield. If I'm okay going a little bit below 7.25%, I might sell the 39 strike just to be able to get a big enough premium. But let's say I go with the 38 strike. Let's explore that. Well, okay. That's agreeing to buy the stock at 38 if I get assigned, if it gets down there. But what if I don't? If I can sell it at 31 cents, 0.31 divided by the strike price of 38, that's making 0.815% over 44 days. If I annualize that, I go times 365 equals divided by 44 equals, well, if I don't get assigned, I'm making just about 6.8% annualized return. Now, that's not really a lot. That part of this I don't actually like. To me, that's just not quite enough. So what I would actually do in this situation is I would probably hang tight, wait for a down day. Verizon dips maybe 40 cents or something like that, and I could sell those puts for another nickel or something. I mean, look at the delta. Well, let's just call it 50 cents. The delta is 17. If the stock is down 50 cents, the puts go up by another 8 cents. I'd be selling these for 39 cents. Well, let's see what that math comes out to. 0.39 divided by 38 strike price equals times 365 equals divided by 44 equals, I mean, that's 8.5% annualized return. It's a little better. It's still not that great, but maybe implied volatility goes up. Maybe I can sell it for more. I really want to get a decent enough skate yield on that. Now, I know for those of you listening to this, I whipped out a whole bunch of numbers, and one of two things. One, don't worry about the numbers. Just understand loosely the concept. Or two, go back and listen to this a couple of times. Really, my objective here is not for you to memorize all these numbers and be able to visualize everything perfectly like in some movie where they're got that invisible board in front of them and they can just move numbers in the air. Like, that's not my objective. Don't worry about getting all the numbers. But if you want to nerd out with it and really kind of get it down, just, hit rewind a couple of times, man. So that is everything that I want to talk about as far as using fundamentals with the trade objective in order to set strike prices. I'll just touch on really quick using technical analysis for the skate objective, but we haven't really talked about technical analysis in the amount of depth that we're going to on our next episode. So be sure to tune in for the next episode. But here's the idea. We use technical analysis for the skate objective trades, meaning I don't want to get assigned, because the whole objective to skate objective trades is I don't want to get assigned. I want to predict that the stock is not going to fall to that level or rise to that level. And so the technicals are used a little bit differently than they typically are. A lot of times, traders use technical analysis to predict momentum, follow through, movement. Here, we're kind of using it the opposite. We're using it to say, hey, I think the stock will not move past this point. I think the stock will not fall below this point or rise above this point. And so one of the main things that I love to use, and we're going to talk about this a lot more on the next episode, is support and resistance, specifically horizontal support and resistance. Those are going to be the skate objective wheel traders BFF. And so you know what? I think I'm going to save that until the next episode. And that about wraps it up for this show. But before you go, please make sure that you're subscribed on your favorite podcast platform, whether that's Spotify, Apple Podcasts, or whatever it may be. And if you'd be so kind as to leave a comment, I would surely appreciate it. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.